Bankruptcies are actually hitting their highest level since the Great Recession, and there may be more pain to come. Christina Partsinevelos is here with a look at, maybe some of the most vulnerable companies as well, Christina.
I know, it's a doom and gloom kind of story right now, but we are seeing a wave of corporate bankruptcies hitting levels, like you said, not seen since the aftermath of the Great Recession. And really, there's some big names that have gone under, from your local Party City to popular restaurants like Red Lobster. Companies are struggling, and here's the kicker. Many of them are owned by private equity firms. Last year, we saw 694 companies file for bankruptcy, according to S&P Global. That's even higher than during the COVID pandemic, which was a tough time for businesses. The biggest casualties, Party City, like I talked about, and then China Construction, each carrying over $1 billion in debt. But you'll recognize other names, too, like Big Lots, Spirit Airlines, Red Lobster. What's really telling is where we're seeing these bankruptcies. Consumer, retail, and industrial companies each made up 28% of all filings. And why is that? Well, interest rates staying high means their debt keeps getting more expensive and makes it more difficult for them to refi. And then consumers, of course, are watching their wallets closely. Over 100 of these bankrupt companies, I should say, were backed by private equity funds, with many in consumer discretionary and healthcare. And that's actually a new record for PE-backed funds. And there's a reason. Private capital firms have been stepping in where traditional banks won't, taking on more distressed borrowers. Now they're facing the same harsh reality of high rates and tight consumer spending that's hitting everyone else.
But I think you make a great point, which is what's different in this bankruptcy wave, even during, since pandemic financial crisis, is high rates. In the private equity companies, if you load up with debt or whatever, and that if that's your whole strategy and it doesn't pan out, so that's where we're seeing a big part of this increase.
Yeah, and it's pretty interesting, too, that the growth rate within the PE-backed bankruptcies is growing at a faster clip compared to overall bankruptcies, 9.3% versus 15%. Could also be their exposure, PE, especially in healthcare. A lot of the bankruptcies are falling within healthcare. Two major names even announced just this year, too.
Which is surprising, because healthcare is supposed to be almost like the recession-proof industry, right? You can't kill it. They're always adding jobs. It's highly regulated.
But then this is where we get a little bit murky in terms of the reasoning. Is it because they are selling the properties that they own, the hospitals, and then leasing it back to their own companies? So we're focusing on shareholder value as opposed to how these hospitals and medical facilities are run. And so that's a big debate right now.
It's also an area now that's under scrutiny from politicians.
Exactly.
Maybe for a reason. Christina, thanks. Christina Partsinevelos.